shaped triangular looking building there around the corner. I always describe it as the weird shaped building. But we've been there for 13 years-ish. It always becomes a blur at some point, maybe 14. It's been a while. So been there a long time. And we do primarily estate planning, business succession planning, and setting up simple LLCs, simple multi-member LLCs, and then how it relates to our estate planning. I just saw you, hello. And how it relates to business succession, avoiding probate, and all of that kind of comes together in one at the end, I guess, for everything. So basically an LLC, a limited liability company. Those of you that have one, hopefully you know kind of what it is that you have, but just to give you kind of an overview, there's two components to an LLC. There's the tax side, and then there's the liability side. And certain industries and people are going to benefit potentially from different sides of that or both, depending on what it is that we are doing, what our business is, etc. Truthfully, on the liability side, industries like a real estate agent or an attorney or a CPA, especially ones that don't have additional employees and stuff, we're not benefiting as much from the liability protection side, because ultimately, no matter what we do on the entity side, you're still the agent. I just tapped the mic, sorry for whoever's listening. You are the agent and I'm the attorney personally, and so that's why we have our E&O insurance, that's why we have our malpractice insurance, because ultimately it's kind of coming back on the person that wrote the contract and whatnot. So while there is some liability protection benefits to you guys in this group specifically, you're also going to benefit potentially on the tax side quite a bit. And so, but some of you may have other businesses. You may have clients that are doing rental properties and want to make a suggestion to them and things like that. So I am going to go ahead and talk about the liability side just so you kind of understand why we do the LLC in general for stuff. So limited liability company means that we are providing we're providing the owners with a liability protection. We're limiting the owner's liability for acts of the company or acts of agents of the company, employees of the company, things like that. And so prior to the LLC, we had a corporation, old-fashioned corporations, and you may encounter them sometimes. And we've had corporations, I don't even know how long, a very long time. An LLC is actually a pretty relatively new entity structure. We didn't even have one in the United States till 1977 in Wyoming. That's where they came, and they weren't even in all 50 states until the 90s, which is actually longer ago than I want to think that it is now, but it's still, it feels like, I'm like, yeah, that wasn't that long ago. No, it was like 35 years ago. But when you were talking about limited liability, the whole idea was, if I'm an owner of a company, why would anyone invest in my company? Kind of at the root of how this all started. Why would anybody invest in my company? Why would anybody have all these employees if I personally could be held liable for something that somebody does that I didn't have anything to do with, or the company makes an obligation that it can't meet, and now this shareholder over here can be sued personally and lose my personal house? So the corporation provided a structure where we could have shareholders that owned a stock in the company, but weren't personally on the hook for acts of the company or of employees of the company, et cetera. And so it works, and we've had corporations for a really long time. The problem is, there's some issues on the tax side, which we'll get into in a minute. It wasn't, the corporation, especially to start with, was not a very flexible structure for taxes. But what it did is it set up a separate entity from the person, and it is a separate voting entity, and that's a whole nother discussion, and it's a separate taxable entity. And the whole idea was, if the company contracts for something, me as the owner didn't, so you can't come after me for that obligation. Does that make sense? And so, but there was all kinds of red tape that you had to go through to make sure that that owner still had the protection. So we have what's called the corporate veil, and that term still applies to LLCs, even though it's not a corporation. So the corporate veil is basically like a liability shield that we're putting between the company and around the company and the owner. And if you keep the formalities, we call them corporate formalities, the whole idea is only the company is liable for debts of the company, for actions of the company, not the owner herself, right? So with a corporation, the problem is you've got to have a very cumbersome entity structure. Two, at the very top level, treat your LLC like a separate entity, or like the separate entity that it is. And that's where we see most small business owners kind of get in trouble. They commingle funds, they pay personal things out of the business. Oh, it's just, well, I'll just charge this to my business card, or I'll just charge this to my personal card and I'll pay. That's where you get into trouble, because what we would be looking for as the attorney, if there's a lawsuit or something, is we want to show that there's a blurred line between the owner and the entity and go, hey, that's a facade company. It's not really there. This person really did do everything personally. So keeping the money separate, keeping it as a, treating it like it's Tesla or Apple or whatever, some big company, is the main thing that you want to do if you have an LLC. And so money comes in, it goes to the LLC account, money comes out, then it goes personally. And there is a quirk with Missouri Real Estate Commission on that, so somebody remind me and I'll come back to that at the end. But in general, we want to keep the money separate. You also want to sign things as your capacity as the owner or the manager of the company. You don't want to sign personally for things. So, if I have a rental property and I'm signing a lease agreement, I don't want to just sign Danielle. I want to sign Danielle, manager of the company, or member if it's a member manager. And so that way, if there's a lawsuit and I'm an attorney and I'm going and filing through documents, I can't go, oh, hey, she signed that personally, or she signed to buy this thing from this vendor personally, or whatever your industry is. The whole point is we don't want to be able to get through and say, facade company really was just her acting and the company was just kind of there. So signing your name on checks, which I know checks, but if you do checks, signing member or manager after your name on the check. Little things like that show that it's the company acting and you as the agent of the company, not you personally. Does that make sense? Other than that, using the letters LLC, like if you have the name, signature, will, and trust, LLC, you got to actually hold yourself out that way. You don't want to put your name out there without the letters LLC, or call yourself something different without filing some additional things to fix that through the state of Missouri. And that's it. No meetings, no annual minutes, no resolutions, board of directors, very, very simple. And that's why you rarely see corporations set up anymore. So does that kind of make sense on the liability side? Now, how do we get our extra liability protection, not just having this set up? The second thing I see that is a problem, and I love my CPAs, and you're going to hear me refer to them a bunch when I talk about the tax side. Sometimes I think CPAs do a bit of a disadvantage for their clients if they set up an LLC for you, because they're really focused, as they should be, on the tax side, and they don't think so much on the liability side of things. And they often don't draft an operating agreement for you. And legally, they're not really supposed to, so they don't do it. So sometimes folks get their LLC set up, they don't have the operating agreement, and they think they're in good shape, when really we're leaving ourselves open on the liability side. So if you've got an LLC set up, make sure you have an operating agreement. And what the operating agreement is the contract between you and your company. And that is where we do some magic things in there. We restrict who can be a member of the company. That's very important in the event someone is trying to attach to our company. We restrict how money distributions can be made out of our company. Also very important if someone's trying to attack our company. And that's all done within that operating agreement. And then if it's a multi-member, meaning more than one owner, that is really, really important and becomes more complicated, obviously. If it's just you, it's just you. Anytime we introduce where we have two or more people that are going to own something, it brings up an entire other list of questions, like what happens if somebody wants out? What happens if somebody dies or becomes incapacitated, or somebody gets divorced? There's all of those things that need to be addressed, and those can all be addressed inside of the operating agreement, buy-sell agreement, kind of work together on that. So it's your contract with your company. And so if we have kept all of our formalities in place, let's say something bad happens and there's a lawsuit, and you've done everything correct in how you have held yourself out as the member or manager of the company, we've kept our corporate formalities in place, and that attorney, nasty attorneys, try to sue you personally. If we're able to keep that from happening, great, but how then further do we kind of reduce what damage they can do to our company then beyond that? And that's where some of the provisions of that operating agreement become really important. And so inside the operating agreement, I mentioned that we can limit who the owners of the company can be. And that's really important. I'll just give two kind of examples, and then, you know, we'll ask questions and I can give more probably from there. But let's say you have a rental property, somebody gets hurt, there's a lawsuit, and you didn't have the right insurance, which is very important, but you didn't have the right insurance, and they're really going after, and they want a piece of that company that maybe's got 3 rental properties in it and things like that. So again, first step, let's make sure they can't sue you personally and they can't get through that corporate veil. If you've accomplished that, next, how do we reduce the damage they can do to the company itself? If you have the proper operating agreement, it should say that nobody other than you, or in the event of a partnership, you know, you and the other person or people, nobody can become a full member owner of that company without the agreement of the existing members. And so what that does is, let's use easy math, because I am not your CPA, so let's use very, very easy math. So let's say you have a company, it made $100,000 net, you got that sitting in the bank account, there's a lawsuit that's gone on, and they win. The people suing you, the judge bangs the gavel and says, yep, we're finding this company liable for whatever it is that happened, and we're going to assign that now creditor, basically, right, a 10% profits or 10% interest in your company. Okay, well, that's not good, obviously, if that happens, but stuff happens. And so what they are at that point is an assignee. What the operating agreement can do is limit what that means. And so in your operating agreement, if we have said, hey, only this person, and a kid, or whatever we say, we limit who can be an owner of the company, that judge cannot make me make that creditor, that assignee, a full member of my company. And our operating agreement has been litigated and stuff, and it holds up. So what did they really get by getting assigned an interest in our company? Not too much, a profits interest, but no voting interest, no ability to make decisions or decide when money comes out of the company or anything like that. So we've got that in place, and then our operating agreement further should say we're really restricting who can decide if distributions are made from that company account, period. So your company in this example, let's say it's made $100,000, and a creditor now has been assigned a 10% interest in the company. At the end of the year, depending on what structure on the tax side that you're set up as, basically your accountant produces and kicks out what are called K-1s maybe, and it says, hey, Danielle, if it's a person, you know, Danielle made $90,000 at this company, you owe taxes on this $90,000. This creditor over here made $10,000, you owe taxes on that $10,000. But now me as the owner of the company, I say, I am not making distributions from my company this year. I'm leaving that $100,000 in the company account. I still have to come up with a way to pay my tax liability on the portion assigned to me. So I've got to have my personal savings or, you know, whatever other income or something to pay for that. But essentially this creditor just gets a tax bill that says, hey, you made $10,000, you owe as if you made $10,000, but they don't get the $10,000 to pay that. So what's that interest really worth? And that's where we can go back to them, buy them out, kind of, you know, it reduces the damage they can do because their interest isn't worth much. Make sense? That's kind of a game you can play, but if you don't have that operating agreement structured right, anybody can get through it and they could be a full member and now you're just screwed, for lack of a better word, on that, right? And so that's one example on like a lawsuit side of things. Let's say there's a 2-member LLC and somebody passes away and we don't have an operating agreement limiting who can be a member of that company. And this actually is an example. I was working with a client on something else and they had multiple businesses. In one of their businesses, their partner passed away while we were working with them. And that partner had done the right thing. He had done his estate plan, done a trust with his wife and everything, and he had executed what we call a transfer on death assignment, like a beneficiary designation on his 50% interest, and it said if I die, it goes to my wife, and then if they both died, it went to their trust. Perfect on his end, like that's exactly what you're supposed to do. We don't want to take that through probate. The problem was she decided, I'd like to actually continue to be in this business. Well, that is not what our client had in mind when they set it up. It was him and the gentleman, not them and their wives. You know, and it goes both ways. But that's the idea. And all of a sudden she's going, I don't want to be bought out. I want to just continue to run the business. Well, Fortunately, they did have an operating agreement. It wasn't great, but they had one in place. And it said that any transfers without consent of both of the people only transferred essentially didn't make the transferee, I guess, a full member of the company. So we were able to argue that all that transferred was the economic interest of the company, not making her have access to books, be able to vote, be an actual member. And because of that, able to kind of go, hey, just take we'll pay you out what he owned, his equity in the company, but that's all. You're not going to ever be a full member. And so what would have been even better is if they had had a buy-sell agreement in place, which we can do inside of your operating agreement. And if it had said, hey, we're restricting who can be a member, so which theirs did say that, so that was good. But in the event of a transfer upon death or somebody wanting to be bought out, I don't have to do it immediately. I can do it over a 2-year period or a 5-year period where that spouse still gets her full equity, but the remaining owner of the company doesn't have to panic and sell things and try to come up with the money instantly. We've got into place a period of time to pay her out. And those are all things that can be addressed inside of your operating agreement. And obviously some of those aren't important if it's just you as the owner of it, but they're very, very important if there's more than one. Does that kind of make sense? All the things, and that's where we control it all. People passing away, you passing away, being able to dovetail with your estate plan to avoid probate on any of the assets that are in your LLC and kind of handle squeezing out creditors and whatnot. The state of Missouri has an operating agreement for you if you don't have one, and it's not very good. And it doesn't limit who can be a member. It doesn't keep those eventualities from happening. That's why you want, when you're paying an attorney to set up your LLC, it's not to do the filing online part. I mean, we do try to do it all at once because it's just easier and we know some language we like to use and stuff. But really, you're paying for that operating agreement and for guidance on things you should and shouldn't do to make sure that you just didn't pay for nothing, to keep everything together. Does that make sense? Now, there's the tax side. Okay, so that was all kind of the liability side. Not as briefly as I would have thought. I'm very long-winded, sorry. Hopefully it was helpful. But there's a lot of information. So there's lots more examples. I'll leave them for later. Switching gears to the tax side. So an old corporation, thinking way back, very rigid tax structure. The way that we were not able to sue the owners of the company is because the company was a totally distinct and separate taxable entity. So you've ever heard of like the entity having to pay tax at the business level and then the shareholders having to pay tax. Like if you own any stock, if you own, I can't think of anything but like Tesla this morning. So if you own like a Tesla stock, you have to pay income if you sell that stock or if they give you dividends off of it. But that company is also paying tax as they're making the money. Well, for a simple structure where we're not having tons of investors and doing different things, that's a very just cumbersome entity to have to deal with. And we don't want to have to pay. If I've got a small law firm or a real estate agency or I've got a rental property, I don't want the company to pay taxes and then me have to pay taxes on top of it. And so there are certain things that have developed, like a subchapter S filing corporation. It's not a separate entity, it's just a tax status that allowed for some of the income to bypass the company level and just go through to the shareholders. And so there are options that you can do now where there didn't used to be any. But it's still kind of a pain. So even if I have an S Corp where the income goes to the owner, I still had to do, remember all those corporate formalities and all that stuff that we had to do. The beautiful thing about an LLC is we have the slimmed down entity structure, but we can be taxed as anything that we want. So you can have Signature Will and Trust LLC, obviously an LLC, but we are taxed as a subchapter S corporation. But it didn't change that I'm still an LLC, still don't have to do minutes, meetings, resolutions, annual reports, and all that. But on the tax side, I look like an S Corp. Have you guys heard of that? That's the big game that gets played a lot. And so to summarize what it does, again, I'll go back to easy numbers because that's all I can do. So if you made $100,000 in your company, for example, the way the S election works, the point of it is, if you make $100,000 as Danielle or as as an owner of an LLC where I have filed nothing different and it's all just me, you're taxed as a sole proprietor, which means you have to pay income tax, but you also have to pay self-employment tax. People heard about that? You know, if you've ever had jobs with companies where you're getting a W-2, paycheck, if you look at that paycheck, you'll notice there are withholdings on that paycheck, FICA. And that's where the company is paying a portion of it, you're contributing a portion, and that's going to your potentially future Social Security, your Medicare, all of those little things that government says, hey, we want to withhold from your paycheck and collect to put in this pool for people. Well, when you're self-employed, you don't have a company paying half of that for you. You are paying all of it into withholdings, and you have to do quarterly taxes and all that stuff. Well, 15.5% is a lot in addition to your regular income tax, and it adds up after a while. The way to partially get around it is to file your company as a subchapter S corporation for tax purposes. And what happens is you actually become an employee of your company. You're a W-2 employee and you get a salary at that point. And basically there's no hard and fast rule, as with most tax and legal things. It's sort of a reasonable salary that you get paid. And different CPAs have kind of a different breakdown sometimes of what they think is a reasonable amount based on what the whole company's making. So if you have a company making $100,000 and you say, okay, what's an attorney, if the whole company's making $100,000, what would be a reasonable salary for an associate attorney at that company? Maybe we say $60,000 gets paid out. I'll just say me so it's easier to talk about it. Let's say I made $100,000, I become an employee of my company, and I get a W-2 now that says my salary is $60,000 a year. So on that $60,000, essentially, because I also own the company, I'm still basically paying all of the self-employment tax because Danielle, the person, is withholding 7.5%-ish or whatever it is. And Danielle, through the company that she owns, is now contributing that and paying the other half for me, the employee. That makes sense? So on that part, you're still paying essentially that whole 15.5%. But off the bat, the part that the company's paying, now that's an expense. And so I get to deduct that right off the bat. So that's one plus. Well, the bigger issue though is that now in my $100,000 scenario, the employee got 60, I've got 40 now still sitting in the company account, okay? And that now, Danielle, the owner of the company, the shareholder, can take as a distribution, and distributions are only subject to the income tax, not the self-employment tax, because it's a distribution from as a shareholder. And so on the 40,000, I'm not paying any of the 15.5%. Nothing's going into the unemployment or the FICA, et cetera. Does that make sense? And you're saving, and the more you're making, the more potentially tax savings, and that's why people do that. Now you have to make enough that it is worth it, because there's some other disadvantages. There's some things like if you deduct your health insurance, there's certain other formalities you have to do in order to continue to do that. If you're an S Corp, you have to have pay into unemployment, you have to do payroll. So you have to make sure that the breakdown makes sense, that you're saving enough on the taxes that it's worth incurring the extra expense of being the S Corp. But if it's going to be your full-time job, and especially if you are going to have other employees anyway off the bat, where we're already setting up the payroll and already going to pay in unemployment, it starts to shift as to where it starts to make sense. But we always defer to the accountants on that, and that's their job. They're good at it. They're going to run the numbers, and everybody's going to have a slightly different opinion on when it makes sense. But that's their job, is to kind of lay that out for you, show you the numbers, and then you guys can make that decision. The reason that it's nice to go ahead and have your entity set up, even in an industry like a real estate agency or a law firm where it's a single owner of things, you still want your personal liability insurance, you still want all of that. But the reason I would go ahead and set up the entity now is because 3 years later, it might make sense to do the S election, and your CPA might say, hey, let's go ahead and do that. Well, now we've had our bank accounts already set up, or in different industries, maybe we have vendors that we buy stuff from under our personal social. We have all of these contracts in place. And now in year 3, for the tax side of things, I got to file the LLC, get a new bank account, redo my tax number with everybody that I'm currently dealing with. And it's just kind of a pain. So for a relatively inexpensive amount, especially if it's just you in the business, just set it up from the start. And even if you're in the type of industry where we're not getting as much benefit from the liability side, you're already got it in place for when it's time to take advantage of some of the tax benefits. So, yeah.
Danielle, can I jump in here with a personal example?
Absolutely.
Okay, and so this this all kind of came up with Tom and me. So I have another business. We set it up as an LLC, my hometown toner business, and we used a different attorney because I didn't know what I was doing. So he set it up for me, the operating agreements, and for the past almost 20 years, it has operated just as a sole proprietor LLC. I filed it as a Schedule C on my taxes. I'm not an accountant. I'm not an attorney. This is just kind of a real life example. So we're just going along fat, dumb, and happy with that business. Our Easy Button Properties, same type of thing. We had it as an LLC. Here's the difference is I personally set up that one with the state by downloading a form, copying what I had already had, it set up by an attorney before, and we were just going along fat, dumb, and happy. We started talking about for our real estate business, what does that look like? Do we do an S Corp? Do we do a sole proprietor LLC? How do we file taxes? So Tom's been doing this for over 5 years. We've always just filed it as a Schedule C, but not as an LLC. Reached out to Danielle because we were trying to find out if we were at that breaking point of an S Corp versus just our own taxes and things like that. So you'll want to talk to your accountant and find out what is that threshold. Is it 60,000? Is it 70,000? Because when you're just sitting there thinking about, oh, well, I don't have to pay as much in my self-employment taxes, that's great. But the flip side of that is it's more complicated. Now, if you're going to tell me if I'm wrong.
Nope, that's right.
Now you're going with an S Corp. Now you have taxes and reports that you have to deal with. Now you have to do your own paychecks. Now you have to do all these things, and you can't transfer your money back and forth.
Correct.
As easily. So we do have
Shouldn't.
Tom and I do have a separate bank account for Tom and Carrie Real Estate. And this was something I jumped up and I talked to Caesar about. KW has to make their checks for commission.
That's what I was going to talk. Yep.
Yeah, they have to make their commission checks out to whoever has the license. So they can't make, just like with Brandy's company and with our company, they can't make the commission checks out to O'Connor Real Estate LLC. They can't deposit those in there. So they have to deposit them into an account for Tom and Carrie, because those are our commissions. When then I have to write that check out into a separate LLC account to turn around and write a check back out to myself if I need to be able to pay the real estate credit card. So it sounds good to save on that self-employment tax, but there's a lot more hoops to jump through on that. And that's where you need to talk to your accountant and find out, does it make sense?
Correct.
When Danielle and Salvatore set ours up for us, because I wanted to make sure, even though I had done it personally myself on a different business, I knew that at some point I'm probably going to go S Corp, but I wanted to make sure I did it right. So they did our trust. I came to them and I said, can you guys do this? We thought we were going to go S Corp filing for 2024 when we did our taxes. We're not quite there yet. So it didn't make sense for us to make the jump from an LLC to an LLC S Corp tax filing standpoint, because there's too many other hoops to jump through. Once we get there and we're making all this money and it makes sense, then it's worth the hoops. So check with your accountant to make sure.
Absolutely.
Because it sounds really good on the surface.
Right.
But it's a lot more complicated than that. And you can't get the checks into your business.
That, and if I can comment on that.
Yeah.
So that is a really weird deal, and Kansas doesn't do it that way. And somebody who has an insight to the Missouri Real Estate Commission, this really is something that needs to be addressed, and I don't understand it. One of the ways you keep liability protection, as I said before, was keeping the money separate. And the way that the Missouri Real Estate Commission, they won't let you keep it separate. It has to hit you personally. And I get it because you're the personal agent and you're the one getting the commission, but it's not like that in Kansas. In Kansas, you can pay the LLC account. And so that's why I say for your industry, making sure on the liability side that you've got that good E&O insurance and everything, yes, does help.
So I have a question regarding this and this, because I've been dealing with this myself. So my accountant said I need to get a license with my LLC name.
I don't think they'll let you in Missouri. That's the problem.
They won't let you. You got it.
You can in Kansas. They won't let you, or you can do it some way in Kansas that it works and you can do it.
You cannot get a license, because
It-
that's what my accountant
Yeah,
said.
no, they're right.
You can't write the check
Correct.
to the LLC.
Right.
Correct.
It's got to go to me personally, and so.
You have to have the and this is another thing that we
Yeah.
found was kind of weird about Missouri. So you know how when Darren has taught these classes on, you have to have your fictitious name, and you know,
yeah.
in some cases. So in our case, we've got Tom, we've got Thomas. I think Chris Bradley went through this. Depending on how she's got her name and advertised and stuff like that, we had to file like 8
Oh, it's more than that.
LLCs. It was crazy.
Get
It was a
fictitious.
ridiculous amount. And when I was talking to Danielle, she said, well, Tom and Thomas is the same thing. I'm like, not with the Missouri account. No, they want it all separate.
Yeah.
So, same thing with our LLC when we set it up. The O'Connor team, O'Connor Real Estate LLC. Like, we have several versions of fictitious names, which they took care of at the same time as setting the LLC up. So, straight to check.
And the reason is there's a reason, if I can, before I forget. So that's important. So that ties into the liability side of things. So when I said before that there was a few things you had to do to keep that liability protection, and I very briefly mentioned one of them was using the letters LLC and after your name, if that's how you're holding yourself out. The way we get around it, what a fictitious name is, or sometimes you've heard DBA, doing business as, same thing, Missouri calls them fictitious names. Kansas doesn't even have them, so there you go. But Missouri has them, fictitious names. The way we get around it and make it work, and the key to doing it correctly is what I've had people do. They come in with their paperwork, they did it themselves, well, fine, but when they do, they show us, oh, we got a fictitious name. We have signature, will, and trust without the letters LLC, because maybe I don't want it on a logo, or I don't want it on a sign, or I want to be able to also say Scavuzzo Law Firm, how we started, that kind of thing. The key is, though, they'll come in, they show us, well, they personally filed and own that fictitious name, which defeats the purpose of the LLC. So the key is when you have an LLC, that the LLC owns the name. So Signature Will and Trust LLC owns the name Signature Will and Trust. No LLC. Owns the name Scavuzzo Law Firm. So that way, everything at the end of the day, this is all about the liability stuff. If there's a lawsuit or something involving, or you have something you're buying out, you're doing a Jimmy John's and you want Scavuzzo Enterprises doing business as Jimmy John's, Scavuzzo Enterprises owns that name. So if there's a lawsuit, when we go and we follow the rabbit trail, it doesn't lead back to me personally, it flows under the LLC. Little things like that, not a big deal until they are, but those are things you do.
Okay, so I have another question.
That's all right.
So the thing is, okay, we want to avoid paying that Social Security and all that stuff. But don't you kind of want Social Security so that when you're older you get Social Security?
I mean, no, I don't, but that's just me. I mean, I'm all about reduce the taxes, reduce the taxes. It doesn't affect you. Boy, that could go into a whole nother thing.
Yeah,
so you can definitely have an opinion on that. In terms of, you're still paying in, we're just reducing the amount. We're keeping more in your pocket now. You're still paying in, you're still eligible for Social Security and stuff later. You're still doing all of that. So, and it's not gonna affect, no, because your earnings personally are still gonna count. At the end of the day, when they do your calculation, however that works, to see what you should get, you still made that money. So that is still gonna increase the number that you're gonna be able to receive. Because that's how your Social Security is based. It's based on what you made during your life. You're still making that money. You're just making it as a distribution from your company, not as the employee of the company. So it's still counting towards your end of the day powers that be calculating your Social Security, but you're saving it on the lower end. Does that make sense a little bit?
A couple different things. If you're digging into the accounting, the finances, all that kind of stuff, that's a whole other thing, and you're gonna need to talk to your accountant. Make sure you have a good CPA that
100%.
knows how to deal with real estate, because it's a little bit different. From a banking standpoint, like what you were talking about, how you sign checks and things like that. And this is gonna depend on your bank. Your bank may let you have a totally separate account. So Tom and I have a totally separate account. We've been operating that bank account separately from day one. So I'm not commingling the funds and things like that. I just write a check out for whatever expenses that are specific to that. So it makes it simple when I do my taxes to know that those are expenses. But it's a personal account for Tom and Carrie O'Connor. That's how we've been doing it. Now she tells me that I have to go get an LLC, a business bank account, which is fine. That's what I've been doing with my hometown toner business for 20 years or 19 years. When I sign that check, it's a HTTI check. I sign that check, but I sign it Carrie O'Connor, manager. So I'm signing it for the company, because obviously hometown toner can't sign anything. They're not a real, I mean, they're an entity, but they're not a person that can physically write a check. So you have to put that manager or
Member,
whatever,
whatever,
member or
and we go
whatever,
into that more
because
later
when
as
you
far as,
sign it, you're designating, I'm only representing.
I'm just
this.
proud you remember that. That's very good. Good job. Yes, no, that's awesome.
So-
Sometimes it sticks. No,
She's
that's
giving you
great.
all the great information.
Does that give you an
and I'm trying
overview
to
a little
help
bit
bring it down
on
to,
it?
like, how we're using it.
Well, and
Not
on the
bringing it
real
up too
estate
much.
side, no, you're good. On the real estate side, it is what it is, how Missouri makes you do it. And I would just think of it as this. You are an agent for your LLC that you set up. You're getting those commissions, but your agreement with your agency is that you're turning around and kicking that back up to the LLC. It just is an extra step. If you can do it all at one bank and work out some internal transfers and stuff, it won't be that bad once you get used to doing it. But that's why I do say on the LLC liability side, slightly different for folks in your positions than it would be should you open a rental or restaurant, all of those kinds of things, because it's just treated differently. And that's why insurance is important no matter what you're doing. But that's all the stuff we'd help you with or somebody help you with. I do think it's important to go to somebody to get you set up. One more quick thing at the end to tie it all back. In that operating agreement, again, because I would be remiss not to mention this since this is our forte, we also want to make sure, again, if you pass away or become incapacitated, that we are able to have the tools in place where we don't have to take that entity through probate or your interest in that entity, if it's a partnership, through probate. And the operating agreement allows us to put the proper language where your trust or your spouse could be an instant member of it. We're avoiding any of that red tape. And it all just kind of ties back in together. Does that make sense? I mean, I know it doesn't, I didn't go into it, but in general, does that make sense? So that's what we try to do.
One thing that, you mentioned Kansas,
Yeah.
and this was something that you and I talked about at the conference table,
Yeah.
and I didn't realize. All the things she's talking about are primarily as it relates to Missouri. A lot of us are licensed in Kansas and Missouri both.
Yeah, that's a
You
good
have to do
question.
the same process in Kansas with a Kansas.
Well, you don't have to
thing.
redo it
No,
all.
but
You should
need-
register
you
it
need
in
to
Kansas.
register it and that kind of
Yes,
thing.
yes.
When we talked about it, she said, how much of your business are you doing in Kansas? We don't do a lot, and probably a lot of you in here, because we're located in Missouri, we're licensed in both places, but probably most of our business is in Missouri. So it's kind of this gray area.
Yeah, because of
And we
what
need
you
to kind
do.
of Look at it, when does it make sense to make the step with the Kansas part of it also?
So you can be a Missouri LLC, thank you for bringing that up, and then registered as a foreign, they call it a foreign entity in a different state. So if you are going to be selling properties, the correct legal answer is you should be registered in that state. Again, we're all weighing, you know, if you're not doing very much over there, it's a one-time thing or something. But if you are actively doing business, especially let's say you're a construction company and you are doing physical work in that state or physically going over into that state and doing things, really important that your Missouri LLC is properly registered in Kansas. If there was a lawsuit or something involving the actions that you did in that other state, not being properly registered can kind of limit your ability to fight that, countersue, et cetera. And that brings, you know, when you set up the LLC, there's a registered agent. We would get into all that in more detail and stuff. But if you're doing business in a different state, technically you should be filed to do business in that state. So that's all something that you talk about.
Well, and because you all set up our trust, and at that time, we were able to roll our easy button into that. We were able to roll our hometown toner business into that trust. And in this case, then when we set up the real estate one, I just had to call her and say,
We just had to do a couple
Let's
extra
just
documents
do
to
this, and we
dovetail
just
it all.
rolled it all in there. So it's all encompassed. So if something were to happen to Tom and me, it does fall into the trust. And if you try and download your stuff or file on the online and that kind of stuff, there's a lot of nuances that I didn't know before, but totally makes sense now. So that everything is protected, everything is in one place. You're doing it the right way, so that there's no loopholes like an attorney who wants to sue you. You know, you already know that you have that stuff in place, and it can be really complicated or sound really simple, but there's a lot to it.
There's
But
moving
anyway,
parts,
just get your
moving
LLC
parts.
to start with, and then you can kind of go from there if you need to.
Does anybody have any other questions? I went fast. There's a lot of information. I ran through it, but hopefully it made some sense and gave you a good overview. Okay. Well, if you have other questions or you want to talk about it, you know where we're at. We got some cards. Feel free to grab it. I printed off some our basic stuff we use for our estate planning stuff because that's what we do and it all ties together. So grab those if you want, and it kind of even refers to some LLC stuff in the brochure thing. But yeah, we're available. Any questions or anything like that, just holler, and I'll stick around for a few minutes if you have more questions now. Or Salvatore.
So thank you so
Yeah.
much, Danielle. Scavuzzo,
Thank you.
and
Thanks for having us.
Yes.
Yeah. Hey, we found one.
Was there a question on this, why we had to file?
Oh,
Yes,
I can
yes,
answer
yes.
that. What was that called?
FinCEN.
You tell what it was. Go for it, Salvatore.
Yeah, so basically, generally speaking, it's gone away completely. If you are a non-U.S. citizen or the company is a foreign company doing business in the U.S., but if you're a U.S. citizen, that's a company that's domestic U.S. company, it's gone away for everybody. It was a filing that, if everyone doesn't know what I'm talking about, that came out last year, that that basically anyone owning, the few exceptions that were very complicated, and believe me, including the people that set it up, no one was totally understanding how this was going to work, which is why it kept getting pushed back. And the idea was you went on a government website, you gave them, they wanted to know who were the people behind the company, so that you had to give them your driver's license, personal home address for all the members of companies, and then permanently update them forever, including if any members got a new driver's license or moved. Anyway, they decided finally that that was overly burdensome on everybody. So they essentially just said the whole point of it is to track people that are trying to do sort of offshore stuff and hide money. And so they said, let's just keep it for essentially foreign companies doing business in the US, or if you're a non-US citizen operating a business here. But otherwise, it's essentially just completely gone away, that whole filing. So yeah.
After everybody went through
After,
all
yeah,
that
a lot of,
and set up all kinds of mechanisms to assist clients and stuff, so
it just
you
went
don't have
away.
to worry about that. It went away after they made everybody jump through tons of hoops.
So
Thank you for reminding me about
Well, as
that.
a matter of fact, for our two LLCs, our Easy Button and my hometown.
I think we waited, didn't we?
No,
Or did you
I had
do
already
it?
gone
Oh,
online
okay.
and done it because I was scared to death I was gonna get all these fines. Then when you were working on ours, we didn't end up doing it because it was still kind of in the works, so I didn't even bother with that. But, yeah, we don't have to worry about that now. So, no panic, nobody's gonna get charged fines by the day.
Well, it was a $500 a day
Per
fine.
day.
You
There
talk
was
about.
also, it would have never been enforced because
Yeah,
there was
we-
no notice to anybody because no one even knew about it. So they just apparently.
We
people
kept thinking it was
sharing
gonna get
posts on
overturned
Facebook
and
because they
telling,
thought
but
people were gonna know about it.
yeah. Or one of our friends that's at a business firm I was telling earlier, they set up, they're a huge business firm, and they actually hired additional people and like had a whole process involved because they have thousands of business clients, and like went through a whole thing setting up a little subdivision to handle all the filings for people and how they were going to charge and all that, and then it went away. So yeah, but hopefully I'm glad it went away. It was annoying. So
Are there any other questions?
yeah, any other questions for us?
Oh,
Yeah, sure, we'll hang around, you bet.
So,
Thanks for having us.
again,
Appreciate
thank
it. You bet,
Danielle
anytime.
Scavuzzo, Salvatore Scavuzzo. They are right down catty corner from the post office at
Mhm.
that where the light is and that
The weird
right
building.
way.
The weird building,
Yeah,
the weird shaped
but they're just
building.
right down the street. Highly recommend them. There's a lot of
Thanks,
attorneys
Carrie,
and stuff
appreciate
like
it.
that, so, they're not paying me to say that.
I appreciate it very
But if
much.
you guys have any questions, you have any questions for me, or.
Yeah,
for
we'll
you
hang
all,
around and talk, and if, we're always happy to have a phone call or whatever later too, if we need to, so.
Thank you so much
very
for your
much.
time. This
Thank
was
you,
awesome.
thank you, Carrie, appreciate it.
Let us know if you have any more questions.
Yeah.
And we're gonna talk. Good, okay.
So I have a question, and I didn't want to do it in the class because it doesn't apply to everybody. So we set up an LLC. And then my accountant says, you can't.
You know, I always see people playing on body back.
He's right.
So,
But.
he's, so he's. And I'm like, so I'm thinking, so he said, you have to get.
But I learned that I'm other.
And so he said, realtors do.
And you can. I wouldn't dissolve it, I would just tell you that you're gonna pretend like you have an agreement.
Caesar took it when, he didn't tell, he walked out. Well, I thought he was just taking it back here to get it.
And your agreement is that as you receive your commission, it is owed to the LLC. Just run it through that way. And I would just, that's what everybody
Put
does.
that in our article.
I would.
So I need to call you.
That's what everybody says. He's right about how to do it. However, my real estate clients, most of the CPAs around here just sort of close their eye to it and basically get your account and just immediately transfer to the
See,
LLC.
that's what you do is like, this is not worth
Depends if you're not gonna go to jail. It's not dishonest. You're still paying, you're not getting around anything that you would do without it. What it is doing though is not giving you
I got
liability
several
protection,
people I'm
most
sending
likely.
to you guys.
Oh, awesome.
You have it as an agent
I
anyway.
think my appointment's at the end of the month
That's
next
where,
month.
you know,
Okay.
really comes
Right.
in. There's nothing, I don't know what
Laura
it's about.
Crotty.
There's nothing illegal.
Oh, okay,
It's
yes.
still running through
Okay,
your
absolutely,
LLC.
yes,
You guys
sorry.
did my mom.
Oh, yeah, I remember, yes.
Yeah.
So it doesn't matter.
Yeah, so I think, so
I mean,
we had said.
I've got
It
like
helps if
3
I
or
was
4
running
lines.
across.
Oh,
Sorry,
that's-
At this point, my eyes are so bad that about
Right.
2 feet away or more faces start to become a little bit blurry.
I have a cataract, so my eyes, this one's really blurry anyway.
I don't need to tell you to change.
I
A little astigmatism.